Hello, everyone, and good morning, good evening, wherever you are. Welcome to this session on the ISTAT Learning Lab, focusing on the ABS aviation market. This is the 5th year in a row that I believe we are running this series, always done by both Evan and John. And this update is typically done in September with the benefit of the issuances over the past 9 months and a good visibility on the rest of the issuance before year end. Today's presenters, as always, Evan Wallach and John Mowry. Evan is currently co-president and co-CEO of Global Air Finance Services. He has devoted his entire 35-plus year career to the aviation industry. Prior to forming Global Air Services, Evan held senior finance positions at Jefferies, Guggenheim Securities, and Piper Jaffray. The other presenter that we have today is John Mowry. John is managing director at Alton Aviation Consultancy and brings nearly 25 years of aviation industry experience to his global client base. John is a trusted advisor to lessors, debt as well as equity investors, and is an accredited ISTAT certified appraiser. John started his advisory career with SH&E and ICF and began his career with GE as a design engineer with GE Aviation. So with that, a few housekeeping matters as well. We will have this presentation lasting approximately 45 minutes, which will then be followed by a Q&A session. I would encourage all of you to submit your questions via the chat function on the app, and to do it as and when you have these questions rather than to wait till the very end. And with that, I will hand over the mic to Evan and John to run the session.
That's great. Thanks, Marilyn, very much for your introduction. And Evan and I are very delighted to have the opportunity to participate in this ISTAT Learning Lab. And as Marilyn, you noted, this is our 5th consecutive, and it's just a delight and a pleasure. Our objective is to share with the ISTAT community an update on dynamics in the aviation ABS market. And so from agenda perspective, just to orient folks, I'm going to start off updating on 2 areas. The first is going to be the dynamics of the broader aviation and airline industry market environment, as well as the broader aviation financing market environment, because that's, of course, the aviation ABS market sits right between these two. And then I'll review some of the characteristics of some of the pre-COVID issuances. Evan is going to then jump in and take the audience through how these pre-COVID issuances have performed. We'll then repeat that. I'll speak about some of the characteristics of the post-COVID issuances. Evan will talk about how they have performed in the market. We'll then repeat, and then we'll circle back around to a recap and outlook for the future. As Marilyn said, we'll look for any questions that arise during the course of the session, but if any remain at the end, happy to do Q&A at that point as well. So jumping in, we just begin with the first topic and review here of the macro industry environment. What we're looking at here on the slide on the left are trends in air traffic demand, and then on the right is an indicator of supply in the form of parked aircraft. If we focus just on the left-hand side first, what we see is that despite the severe impact of the COVID-19 crisis, traffic levels in many of the different global regions had rebounded, matching or even exceeding the pre-pandemic levels by the year of 2023. Last year in 2024, on an annual basis, we saw a full global recovery of air traffic demand, and even traffic demand was higher than we were in 2019. Here, where we sit in 2025, looking month by month, we've averaged around 6 or 7% higher in terms of air traffic demand relative to where we were during the same months in 2019. So continuing to see growth over that pre-COVID period. I think it is interesting to note, and you can see from the slope of the curve shown on the screen, the rate of the demand increases is for sure moderating. this is to some extent to be expected. There was a lot of recovery that needed to take place because of the COVID pandemic, and we're now getting back into a period where we would expect that air traffic demand growth would be more correlated with growth in economic activity as opposed to sort of a boost from the recovery. If we look at the dynamics on the right-hand side, we see the parked fleet has moved very substantially over the course of the last 5 years. At its worst, around 7,300 aircraft were parked in 2020, and that represented around a quarter of the global fleet. But after that spike from parked aircraft, we've seen a continual and continued decline in the number of aircraft that are parked. Sure, some of these aircraft have been retired and parted out and disassembled, and the engines, green time leased. But many of the aircraft have been reactivated and put back into service. As of July 2025, when we pulled these statistics, there were around 3,000 aircraft still parked, which equates to around 9% of the global fleet. This is down 4,000 from the worst, but it still is a bit higher on a number basis compared to where we were before the pandemic. We've segmented on the chart the trends between parked fleet by different age buckets, and I think you can see that we have, for the very young aircraft, we've seen a bit of an uptick in the parked aircraft over the course of the last couple of years. It's starting to ease. But some of this, a good chunk of this fleet that's parked is related to some of the durability problems that have been experienced by the aircraft powered by the geared turbofan engines. So some durability, some manufacturing challenges have caused groundings of these aircraft. Our latest count was around 500 A320neo aircraft or on the ground, and around 50 A220 family aircraft on the ground, most likely because of these technical challenges with the engines. But in positive news, we do see that slope is declining, and it's certainly not for a lack of demand for the aircraft that we're seeing these aircraft parked. So what does this mean in terms of, we obviously see the strong traffic demand recovering, the supply coming down. As you might anticipate, this is translated through into enhancements in values and lease rates for a number of the aircraft. Of course, the dynamics will differ on any given aircraft model, and see different trends between narrow bodies and wide bodies, Airbus and Boeing, current gen aircraft, next gen aircraft, and age. But what we've shown here are a sample of aircraft that have a high degree of relevance to the ABS market. And since over the course of the last decade, these 4 aircraft types have accounted for around 60% of the total value of the portfolios at issuance. We're starting to see younger MAX and NEO aircraft coming into the portfolios, but they're usually coming in on very long-term leases. And so what's happening, the rents and the cash flows are highly contracted for those. Whereas what we're seeing is that there's a natural turnover of 737NG, A320ceo, 777 and A330 that's starting to take place. And it's those dynamics of when a lease expires and requires either an extension or a remarketing event, that changes in lease rates can drive changes in cash flows for the ABS securitizations. So that's why we've chosen to profile these here. I think if we look at the top, we can see the highly liquid 320ceos and 737-800s, very similar trends across both aircraft types, just slightly different in quantum. If we look at the A320 as a representative example, back in 2019, a 5-year-old asset was from third-party appraisers had a market lease rate of around $267,000 a month. That dropped to $172,000 in the depths of COVID. That's around a 35% reduction. But what we see is a very continued march steadily upward. And right now, the same appraiser reports that a market lease rate is around $292,000 a month for that aircraft. So it's 10% premium over where we were before the pandemic. Similar trends, again for the 737-800. On the wide body side, what we can see is that according to the appraisal database here, wide body lease rates here dropped by closer to 50% as compared to the narrow bodies above, which dropped closer to 35%. So a more substantial decline shown here. And the appraiser reports a more modest increase in lease rates. Our own internal intelligence here at Alton would suggest that perhaps the lease rates declined by even more during COVID than shown in this data set, but that we've seen a more substantive recovery as well. So our own sort of intelligence does suggest a bit more volatility, both on the way down, but also a stronger recovery on the way up as well. If we look at, we think about leasing, from the perspective of an ABS investor, of course, there's an asset play in the form of future rents and residual values, but there's also a credit play in the form of the contracted lease rents. So we have to look at both. The chart that we show on the left here highlights trends in reported financial ratings for more than 100 different airlines in a rated universe. To be clear, these aren't formal credit ratings. They don't have any qualitative considerations, but they're scaled financial metrics that are helpful to look at and review trends over time. I think what we can see is that during the depths of COVID, what we saw was that a lot of the BBB and the BB financial ratings for the airlines drifted downward into the CCC and CC territory. But there's been a continued improvement since that point in time in 23, 24, and even continuing now into 2025. And this is despite the fact that many of the airlines had to take on pretty substantial debt loads during the pandemic. But we've seen that the overall distribution of credits today isn't very dissimilar to where we were before the pandemic. There's for sure a mix. There are some airlines who are well capitalized and performing very well financially today, and there are some airlines who are facing more significant challenges. Azul, most publicly perhaps operating, operating well, but didn't have an opportunity to restructure some of the liabilities during the COVID-19 pandemic. Fairly recently filed for Chapter 11 here in the United States, and is undergoing a restructuring at the moment. Spirit Airlines, of course, more recently filed for its second Chapter 11 bankruptcy within a year. This time, during the first bankruptcy, there was some restructuring associated with some of the bonds. This time, still waiting to see, but it appears perhaps a more, more significant review of the business model to come here. So a mix of credits still exists, but overall, from an industry perspective, as we can see on the chart on the right, airline industry revenues continue to tick up. I think in where we are in 2024 was around 15% higher or larger market in terms of revenue compared to where we were in 2019. This year, we're expecting a revenue growth rate of around 1.5% over the last year. So continued growth, but at a slower rate. From a profitability perspective here in 2025, expecting, again, continued a small increase in profitability, not too significant, but it's being aided by moderate fuel prices together with record load factors for the airline. So overall, I think a fairly healthy environment, and certainly an improvement from where we've been in the last few years. Let's flip then to move away a little bit from the airline space, but look at some of the trends in the aviation financing market. I think what we can see here is, we're looking at base treasury rates in a very near term over the last 5 years or so, and then over the long term on the right-hand side. The near-term picture is quite evident. Interest rates were cut very substantially during the COVID pandemic. They started low and were cut more significantly, but they've been easing or increasing quite substantially after the Russian invasion, and inflation moved up and interest rates moved up as well. Today, 7-year treasuries are around 2 times higher than where they were pre-COVID, and they're 10 times higher compared to where they were at the depth of the COVID environment and maximum sort of quantitative easing. Of course, base rates aren't the only determinant of financing costs for the lessors, and we'll discuss trends and spreads a bit later in the conversation. I think, theoretically, we'd expect sort of these higher interest rates to cascade through into higher rents. We've definitely seen that taking place in the sale-leaseback market. There was probably a lag associated with the timing of those increases in lease rates in the sale-leaseback market, perhaps because some of the lessors had already raised capital at lower costs and were able to still deploy that. But we've seen that come through. In the secondary market and in the placement market, we think it's a little bit less around in the short term. It's less about the cost of financing, but it's more about the supply-demand environment, which has tightened quite considerably. And so we think that that's been the most significant driver of improving lease rates in the secondary market. And that's been important for the lessors because they've experienced the higher interest rates here. I think, interesting again for sort of the longer term perspective, looking at the chart on the right, today's interest rates are similar to where they were back around the time of the GFC, so around 15 years ago. And it's the last 5 years with this interest rate uptick has been a pretty different trajectory as compared to what the sort of industry's long-term historic experience was of declining rates. And I think that has, that's had some implications for, the ability of lessors to trade and values and the like. But we're fortunately in this strong demand environment at the moment. So when we're shifting away from sort of base interest rates, if we look at financing volumes, we're looking over the last 10 years, we see that the total market for commercial aviation financing has been around $1.5 trillion, so quite substantially. It spiked. It was $150 billion, pretty steady pre-pandemic, spiked up during the COVID environment. The airlines needed to borrow significant amounts of capital. They did so in 2020, and they were supported by the quantitative easing. 2021 was a big year for lessors who took advantage of the lower interest rates and financing costs and borrowed record sums to help support merger and acquisitions. They termed out a number of the warehouse financings and the like. Interest, as we showed on the prior slide, interest rates spiked in 2022. And that caused the dearth of new financing activity. Even though interest rates have remained elevated, we've sort of gradually been getting back toward the $150 billion level that we had prior to the pandemic, but still below those levels, but moving in that direction. I think what we see from the data, there can be a little bit of a lag in some of the commercial loan data that we see, but where we're sitting right now from figures we see is that total financing to date has been around $65 billion year to date. This compares to last year when we did this presentation for 2024, we were sitting at around $70 billion. So roughly in line on a year-to-date basis where we are today compared to last year. And you can see the amount of financing that was implied in Q4 of last year, moving from around 70 billion to 133. We're expecting some quantitative, there may be some interest rate reductions here, and we may see a significant amount of activity in 2025, which could lead us toward, toward a full year-end number aligned with last year. Remains to be seen. One layer deeper, if we look at the debt capital markets alone, this is obviously a subset in which aircraft ABS sits, but there are a whole aircraft ABS is actually a pretty small portion of the overall debt capital markets. It runs around 8% of the debt capital market financing activity. Most of the activity in this space is related to unsecured bonds from both lessors and airlines. The structured products of EETCs and ABS are important, but smaller portions of this broader market. I think when we look from a trend perspective, I think since 2022, the market's been less attractive because of the higher interest rates. But there's also been a little bit less need. Those airlines, lessors raised records amount of liquidity in 2020 and 2021. And so haven't been looking to refinance that very attractive low cost of debt in this market. And then I think, of course, another contributor to the decline over the last couple of years is that the volume of new aircraft deliveries has been lighter than where we were pre-pandemic. And it's, of course, new deliveries are so capital intensive, they require the financing. Because the delivery volumes have been lower, there's been less need for financing, and that trickles through down into these capital markets. But we are seeing, some uptick. I think, in 2025, we'll see how the year ends. If we look just at aircraft ABS issuance, I think, again, if you look at sort of the lines, or rather the bars in green, we show the value of ABS issuance over the course of the last 10 years. And I think, we see sort of, a growing environment into 2019, which was the all-time peak of issuance at close to $9 billion. 2020 was soft. 2021, amidst that quantitative easing, we saw a wave of activity close to $8 billion of issuance. And then it got quiet again in 22, 23. But for sure, we're seeing a ramp up in activity in 24 and 25. I think that the second piece, and we'll talk about sort of the current market shortly. I think the second piece of this chart is really, the relationship that we've seen historically, or like to look at, is just between the amount of ABS volume and the amount of secondary trading of aircraft amongst the lessors. And so the outlined bar next to the ABS volume represents the value of aircraft that were traded in the secondary market by lessors year over year. And we see, a difference, or we see a relationship historically between these, where on average, perhaps 30 or 40% of the ABS volume totaled around 30 or 40% of the total aircraft trading volume. So we think that the ABS market has been historically important to facilitating that secondary market trading. The way it's done that is both directly and indirectly. Directly is that big balance sheet lessors have historically used the ABS market to sell aircraft with leases attached to financial investors through the sale of E-notes in these structured sales. And then there are trade sales to other lessors. Some of those trade sales, the aircraft go to balance sheet lessors. Some of the trade sales go to asset managers who are deploying capital on behalf of funds. Frequently, those funds are financed on a short-term basis with warehouses, and then look to use the ABS market as a long-term financing solution. So both indirectly and directly, we think the ABS market has been supportive over the years of this secondary activity. So the hypothesis is that as the ABS market comes back, it helps facilitate secondary trading, which we think is quite important for the lessors. I think I will turn it over now to Evan, who's going to take you through some of the dynamics that he's monitoring very closely with respect to the pre-COVID issuances. So, Evan,
okay. Yep. Thank you, John. Just to recap, so we started giving our Air ABS market update in 2021 in response to the drastic impact on the Air ABS bonds from COVID. And each year since, we've been updating the performance of a selected pre-COVID issues as a comp to their performance in 2019. So let's see where we are today. Just this first slide, we want to just, again, we've shown this before, but highlight the Air ABS exposure to restructuring and to Russia. 2 points to highlight. Most of the pre-COVID deals had to be restructured during COVID. And also, no issues since 2021 have had any new exposure to Russian lessees. Since 2023, many of the major lessors have been receiving some settlement payments from NSK, which is the Russian insurance company. And then this past June, a very significant case in the London High Court, which ruled that insurers must cover losses for the seized aircraft. So as a result, many of the pre-COVID issues have been receiving large lump sum payments for their seized aircraft, which has given, frankly, bondholders, primarily the Class A's, some big lump sum paydowns of principal. Okay, next. So this is our performance of rent and maintenance reserve collection trends. So again, looking at the chart on the left, what we're seeing is that while collections per MSN continue to improve, many servicers have been accelerating aircraft sales to take advantage of a strong demand, which has definitely helped pay down Class A debt. But however, the offset to this is that some deals are now getting lower overall collections simply because they have fewer aircraft left in the portfolio. If we look at the chart on the right, which is the DSCR coverage ratio, you can see that most are improving as expected from a combination of higher collections and also reduced debt balances. But you can see that many are still way below the 1.15 times threshold at issuance. Next. So these three slides, we're showing where things are with the A's, B's, and the C's. So the good news, if we look at the chart on the left, the good news for the Class A bondholders is that principal shortfall has either been stabilized or been reduced from higher collections and proceeds from aircraft sales. However, for the Class B bondholders, since most of the improvement in collections is going to the Class A's, the principal shortfall for the Class B's is actually getting wider. And then worst case for the chart on the right side for the Class C's, the Class C bondholders have not received any interest payments since 2019. And the principal shortfall continues to significantly increase as the interest picks and is just added on to the principal balance of the original of the Class C's. Next. So just a quick snapshot of where things are on ratings. As you know, at issuance pre-COVID, the A's were almost all single A, and the B's almost all triple B. You can see that most of the pre-COVID Class A's and B's are both continue to be downgraded from their issue ratings. But most of the Class A's have come back at least to investment grade in the triple B plus area, even some in the single A and single A minus. Most of the Class B's are still non-investment grade and unlikely that they're going to be recovering back to investment grade, which has a pretty big impact on capital charges for the bondholders. Okay, next. So we wanted to highlight where things are in the secondary trading market. Very positive market for the Class A's, reflecting improving collections and improving market fundamentals. The A's have continued to trade higher, with most pre-COVID Class A's now trading at or very close to par. Again, this is again a reflection of how things have improved for the Class A's with respect to collections. And if we look at the Class B's, next one, yeah. So here we can see, yes, secondary trading levels for the Class B's have improved and have continued higher. Again, some close to par. But we think that even though the principal balances for the Class B's have continued to widen, the market's funny. This could be their view that of optimism for the future, where they think the Class B's may be getting repaid in full in the future. All right, pass it back to John.
Thanks, Evan. Allow me then maybe to preview what we're seeing here with respect to the post-COVID issuances. So I would note that what we're profiling here, perhaps a busy table, but what we're profiling here on this slide isn't the full set of aviation ABS. Specifically, what's included here are a number of the aviation loan ABS, CLO types of issuances that we've seen come to market from PK and Volafin, Ashland Place, and Stone Peak. As well, there has been a market and issuances that have come from the corporate and business aviation side, namely from Global Jet Capital. So those issuances are excluded from here. But what we have here are what we call leasing ABS, including both the aircraft and engine deal. And what you'll see here, segmented by year, we saw in 2022 there were just 2 issuances that closed. A single issuance in 2023. It was an engine deal from Willis Lease Finance. Last year, back to the aircraft side, 5 issuances in total. But the biggest chunk of this page is what we see here in 2025 year to date. 7 out of 8 of these issuances in 2025 are your traditional core aircraft securitizations. Another was a successful Willis engine securitization financing. I think when we look at the pricing of sort of the A coupons, I think what we see is on these Series A notes in 2025, coupons ranging from 5.5% all the way up to 5.9%. But generally, if we look kind of these come in sequentially over time, generally appear to be on a declining trajectory, which to some extent reflects the softening in base rates that we showed on some of the earlier slides. But notably, if we compare, these coupons to the best pricing, the best execution at the depths of COVID, we're closer to 2.5%. So, the money's there on a spread basis. It's attractive. We'll speak about that. But you're looking at 5.5 to close to 6% on the 8s. Down in the bottom of the chart, we see a transaction called Navigator 2025-1. It was just last week. We'll consider it in the market at the moment. Just last week, we saw the pre-sale come out. Interestingly, typically, most of these issuances have ratings from 2 of the agencies. In this case, we saw pre-sales come from Kroll, Moody's, and Fitch, so 3 agencies here. But it would bring notes of $610 million and an LTV, interestingly in this case, of up to 85% on the Bs, which is something we hadn't seen recently. So pushing up a little bit on LTVs. If we trend out some of the characteristics of the ABS issuances, I think we can see a number of different environments. We've talked about them earlier in the presentation, but we've got the pre-COVID 2019, 2020 deals, the 2021, I'll call it quantitative easing deals, and then sort of the 2022 post-interest rate spike, post-Russia. And then we have, sort of a more similar environment here in 24 and 25. So definitely a lot of different periods here for the market. But when we look at the top left, we see where coupons have averaged for the aircraft issuances. And I think what you can see is, relatively inexpensive financing, before COVID in 2021, that quantitative easing made it very, very efficient. And then, the spike in 2022 and kind of the continuations in 24 and 25 with, coupons just below 6% for the A's. I think it is interesting to look at the breakdown between that coupon, between the base rates and the spread. And particularly in 2025, what we can see is that there's a very significant tightening in the implied spread over the base rates here. And that suggests that investors are increasingly comfortable with the risk premium associated with the industry, the aircraft, the credits, the structure of the deals combined is driving that spread lower. So that's a positive for certainly for issuers here. If we look at the bottom left, I think we try to characterize what are the assets and the collateral behind these issuances. And I think we've seen the markets being open for a wide range of aircraft types and engine types. I think we continue to see that the market is open at a certain price for any of them. I think, if you look at 24 and 25, there's a much more significant presence of next-gen narrow-body aircraft, so 320neo and 737 MAX family aircraft, taking on a more substantial portion of the overall portfolio value. Interestingly, to see in some of these 2025 issuances, the wide-body assets have come back into play as well. This is something where it was a little bit drier in the last couple of years as the perceived supply-demand balance on the wide bodies wasn't the same as what it was on the narrow bodies. If we flip to the top right-hand side of the chart, I think from a loan-to-value perspective, significant junior tranches in the pre-COVID environment and in the 2021 quantitative easing environment, when interest rates spike took place, risk was off and the B notes were expensive, so we actually didn't see any junior notes come through in the 2022 issuances. But we've seen the return of the junior notes and to a greater extent in 24 and 2025, pushing to sort of a just below 80% LTV total on average. So interesting dynamics there. I think on the sort of underlying collateral side, again, on the assets going in, historically, the assets going into these issuances have been around 10 years of age and have had a simple average remaining lease term of around 4 years or so. Last year was a bit of an anomaly where we saw much younger aircraft and longer term remaining. This year seems to flip a little bit, where we're seeing more midlife aircraft going into the deals with a bit shorter contracted lease term remaining. So different dynamics at play. I think importantly, some of the tightening on the spreads is related to some of the structural enhancements that have taken place, which Evan will take you through.
Yeah, thanks, John. So, John's highlighted some of the trends in portfolio composition. We just wanted to highlight 3 structural changes that we've seen in not all deals, but in some of the deals. So first, with respect to the waterfall, we've seen a change in the priority of payments, which has now gone for the Class A's, paying them interest and principal, and then paying the Class B's interest and principal. This is a change from the traditional interest to the A, interest B, and then principal payment to the A principal, B principal. What it's done, interestingly enough, is that because I guess the risk profile now for the A's is a little bit lower, it's been able, the bondholders have been able to accept even a lower coupon for that Class A, because it's a true priority of payments. And at the same time, the issuers have been able to increase the size of the Class A, which is always the objective in lowering the overall cost of the issue. Surprisingly, the spread on the Class B has not really widened out that much to reflect the true subordination risk. And the ratings haven't changed much, except for this very subtlety. The rating for the A is now timely payment of interest to the A, and ultimate principal, whereas the B now is rated ultimate payment of interest and principal, instead of just timely payment of interest to the A, because the B is now lower in the waterfall. Secondly, we've seen a master trust structure offered by Carlyle, which they've used for their 2025, both 2025 issues. It's a common feature that we've seen in other asset classes for frequent issuers, and frankly reflects a very high comfort level from investors for that issuer. And from the issuer standpoint, it allows for an accelerated process for the issuer to come to the market with an add-on to an existing issue. So they're very, very effective and very good for the issuer. A very minor change was made to the DSCR calculation. This used to be calculated, it was basically a cash flow test covenant that was put in beginning with the 2014-15 issues. And it seemed to make sense from the standpoint that if you had a minor blip, where there was a shortfall for a couple of months because some lessees were slow on payment or whatever, you would then use this as a way to divert payment to the A's and then recover it to the B's. But no one expected the impact from COVID, where the complete shutdown would happen for the portfolio. As a result, it's gone from a 6-month look back now to a 3-month look back. And it might be effective for going forward, unless we have another COVID event, but to reflect minor glitches in the cash flow, which would basically allow a faster recovery to the subordinated classes. So very minor, but something interesting. We've looked at this chart for the last couple of years as well, and basically it's just highlighting that once COVID hit, it's really taken a long time for the pre-COVID bonds to recover collections such that payments, would make it down through the waterfall. Even with higher collections from rent and sales, many of the post-COVID, pre-COVID issues still are catching up to the Class A's. So the A's continue to get most of the issues, majority of payment is going to the Class A principal. But you can see that we're starting to see on some of the post-COVID issues that those are performing much better. And when you look at the 24-25 deals, you can see that those those issues are paying completely down to the E-notes, which was on schedule. So much better recovery, but still pre-COVIDs are still in many cases behind in their schedules. We also wanted to highlight just the performance of the engine deals versus the aircraft deals, and very clearly the engine deals, even pre-COVID engines deals, continued to perform on schedule during COVID, and obviously the post-COVID issues, the engine issues, are performing all on schedule. So it's very positive for the engine deals. So we wanted to just highlight, in summary, the outlook that we see for the different constituents. So for the current bondholders, the post-COVID issues, the bondholders are receiving principal and interest on schedule. For the pre-COVID issues, most of Class A bondholders are now receiving scheduled principal and interest. Some Class Bs are receiving P&I, and still the Class Cs remain unpaid, with the principal balances increasing from the PIK interest. We've seen 7 pre-COVID issues fully repaid, which is really reflecting both I guess values for the aircraft, and also the ability to be taken out by private debt. We didn't see anything last year, so I think that's a positive for the market. And then in secondary trading, volume on the post-COVID issues is much higher than the volume we were seeing on the pre-COVIDs, again, which reflects, I think at this point, if you haven't traded out of your pre-COVID holdings, most likely as a bondholder, they're just holding now and just saying, okay, hopefully things will get better and continue to improve for us. If we look at the right-hand side, looking at the current E-note holders, again, for most of the post-COVID issues, the E-note holders are receiving scheduled distributions. And for the pre-COVID issues, again, most of the E-note holders have not received any distribution since 2019. There's a few that have, so again, very selective, but they're actually in some of the forecast models that we've used. We actually do show possible distribution way out in the future to the E-notes when bonds are repaid and there's a few aircraft left. So the aircraft sale proceeds would go to the E-notes. With respect to third-party equity, I think it's pretty clear that the bondholders no longer want to see that. They want to see the sponsor retain the equity to demonstrate alignment with the bondholders. And so most likely we're going to see that structure, and maybe that's best for all parties, that you have everybody that involved in the deal that's fully aligned. Next slide. So interestingly, the warehouse banks and non-bank institutions, the warehouse loans that had been extended during COVID, almost all have now been fully repaid from new Air ABS issues. We are seeing new Air ABS CLO issuance really pick up, again, reflecting strong demand from investors. The primary issues being PK, Volofin, and Ashland. And then we've also seen a lot of hedge funds come into the market. We call them non-bank institutions in the private market, offering very attractive financing structures to the lessors as an alternative to larger, public Air ABS issues. And then finally, for the aircraft lessors, we're seeing consolidation at all levels across the market, most recently with the sale of Air Lease to SMBC. The aircraft rating continues to be very robust, again, driven by a lot of new funding sources that are coming in to lessors, to the buyers. And with new aircraft production continuing to slowly recover, current tech aircraft demand remains very strong. It's reflected in the higher lease rates and in the higher trading prices. So back to John for the conclusion.
Thanks, Evan. Yeah, I'll just try to bring some incremental thoughts here. I think, just to summarize, for sure, COVID-19 is in the rearview mirror. Despite the tragedy that still continues in Ukraine for most of the aviation industry and investment community, Russia's invasion is in the rearview mirror as well. I think we've seen, unlike the last few years that had been quite challenging because of the COVID environment, we've seen air traffic demand fully recover. The limitations on new production volume from the manufacturers along with lower reliability or durability of new technology assets, has put the aircraft supply demand situation into a tighter position than it's been for sure in the last 5 or even 5 to 10 years. So it's strong at the moment for asset owners. I think we've seen lease rates, in particular for used and narrow body aircraft like the COs and the NGs, move up quite significantly. They've been very strong. It's probably the case that the rate of increase is moderating, but where they are today, lease rates for those similar aged assets are above where they were pre-COVID. That's important because of the higher interest rate costs that the lessors are experiencing. I think we see air traffic demand, of course, come back so strongly. What we'll see in the future in terms of the rate of growth is going to be less than what we've seen in the past couple of years. But we still expect, and IATA expects, a robust demand environment through the medium and long term. There are always risks that any investor has to be mindful of. They can be specific credit names or business models or tariffs or geopolitical considerations. Terrorism always out there as risks that we all have to be very mindful of. But in general, I think we see there's been a continued thaw of the ABS market. Spreads are tightening quite significantly as we're seeing in the 2025 issuances, and I think there's reason for optimism around volume of issuance here in the fourth quarter of 2025. We think that the ABS market continues to be very important for the issuers directly, but also the market as a whole, because the balance sheet lessors do have a business model. They seek to trade out of aircraft after they're seasoned on the balance sheet, and increasingly they'll need to do that as the manufacturers ramp up production and new deliveries need to be financed. So we expect a growing market from sub 100 million today to cross $100 billion next year, and advance up toward 140 billion plus by the end of the decade. So we see a near-term, medium-term, healthy, growing market and continued opportunity for lessors and investors in this space alike. I will turn it over to Marilyn, because I think that's our formal presentation, to see if we have any questions from the audience.
Thanks, John. Thanks, Evan. Definitely a very interesting presentation, and it looks like the future is bright. It can only get brighter. We do have quite a few questions that have come through. I'm assuming that you can both see some of these as well. We may not necessarily be able to get through all of them, but if we take them in turn and see where we get to at the top of the hour, shall we? So the first one that's come through is, crystal ball, John. Under what conditions will we start seeing the e-notes being issued again on the ABS?
Under what conditions will we see e-notes?
E-notes.
Yeah, I would say last year at this time I was less optimistic, and it seemed, further off. I would say, I'd probably become, I'm sitting in a more optimistic position, this year than I was last year. I think we continue to see, the underlying, the underlying market, as we just discussed, of aircraft and demand is quite strong. The credit profiles of the underlying credits have improved. There's a tightness in supply and demand, and the ABS market is an efficient channel and path for big balance sheet lessors to trade out of portfolios. So it really becomes, I think what was demonstrated, I think the structures proved resilient. I don't think anyone who so the structures of the e-note sale, I think, worked. I think anyone who would have expected a COVID type of environment to come in, you wouldn't have bought aircraft on lease through an e-note or through a trade sale. But if you don't expect that to happen again, there's at the right price, I think there's the e-note product and solutions to make sense. So I think we're actually probably not as far away. We're getting closer.
I agree. So it seems like maybe a 2026, sort of time frame when you'll start to see the first one coming out. And then, Evan, I don't know if you want to take the next one in terms of private credit. Do you see more of these loan CLOs, ABSs being issued maybe for the rest of the year or next year?
Oh yeah, absolutely. I think there's going to be a tremendous amount of new volume of the CLO structure. I think they're performing great. I think the risk structure is very well defined. I think the managers are excellent. So I think it's a great product, and I think again, it's not for everybody, but I think that you definitely have your choice of where you want to play in the structure, more so even in the area ABS structure. So yeah, I think we're going to continue to see more of those issues. I also think we're going to continue to see more private issuance. I mean, example, I think the Castle Lake 2018 deal just got taken out, and completely the refi was done completely privately. So again, I don't know how many participants were in it, but again, it's I think a reflection of that the private market is willing to come in and offer very attractive financing to the lessors. I think we'll see.
Seems like a very efficient tool.
Yeah.
And PK has been using it very well.
Yeah.
Over to you, John, on the next question. Airline issuers haven't really seen too many of those.
Yeah, look, I think the reason for I would say, I mean, there's been less of again, like the requirement for financing is to a significant extent driven by the value of the new aircraft that are delivered and need to be financed. So over the last couple of years, post-COVID production rates have been lower, so there's been less requirement there. We have seen a very strong operating leasing market. So if you look at something like the A320neo, we see like the lessor penetration on that aircraft type is pushing 60, even higher, 65%. So we see the lessors capturing a lot of that financing requirement, which obviously reduces the need for airlines to finance those directly. And then I think the question was around are airlines focused on deleveraging, and for sure that they are. They're generating many of them. The larger airlines typically are generating cash and are using that to delever and paying cash as opposed to issuing bonds where they can. So it's a combination of all those factors, I think, that's driving the trends on the airline side.
Okay. Okay. I think we've sort of answered the next question in terms of the e-notes. I guess it's asking it in a slightly different way in terms of recoveries still being behind, and yet people are so buoyant in terms of the e-note coming back. I mean, I think is that to do with sort of new investors coming in? I mean, what do you think is driving that optimism?
Maybe I could take a contrarian view on that. Yeah, I mean, I think the e-note, the creation of the third-party e-note, was like what, 2018 or 19. Maybe an overly optimistic, exuberant market at that time. I actually think that we're going to see, if we do see it, I think that the bondholders probably would want to see the sponsor at least can maintain a 51% interest in the equity, just to maintain skin in the game and alignment of interest with the bondholders. I think it's a good thing. So if I think if we see third-party tradable e-notes come back again, again, it could be just the market is just so buoyant and strong, that investors are willing to take that kind of risk.
I would just think the question relates a little bit around sort of it makes the comment around Class C recovery substantially behind schedule, and I think that's for sure true. I'd probably caveat the slides that we profiled showing those Class C notes. It was a sample of 4 issuances that we've been monitoring for the last 5 years in particular. But I'd maybe draw the questioner's attention to the fact that there have been just this year 7 ABSs that have fully paid off, and some of those would include Cs. So there have been some issuances that a number of them have performed and fully paid. They've been able to repay in full. So if you had sort of anticipated where we were back in like a pre-COVID environment, if you'd said the industry is going to go back, going to go through a COVID environment where traffic's going to fall by 90%, you wouldn't. But in 5 years from now, the Cs will get fully paid out. That would have been a bit surprising. So I think again, I think for some of the issuances they've performed, and I think there can still be a market for these. I don't know that they will be at sort of the initial highly liquid distributed tradable e-note at the outset. It might be more, the first one might hypothesize might be a more small club equity sort of deal.
More sort of like a private placement type
Yep.
bespoke deal, right? Yeah. So we're close to the hour, but maybe we'll take one final question in respect of the master trust structure. And I don't know if either Evan or John, you'd like to have a shot at this, but the question surrounds the way the structure is created, and given the fact that it's effectively could potentially be blind, because when the first issuance on the trust is done, you don't have good visibility in terms of asset selection. So doesn't that create in itself a risk for the first issuance, is the question.
Yeah, I mean, without going into a tremendous amount of detail, because there's a lot of rules and regs that go into using the structure, but I think essentially it's useful for somebody like Carlyle, which has, I think, issued 19 deals in over the last year. So I think investors are just extremely comfortable with management there, with their structures, the way they performed. So I think for somebody like a Carlyle, it's just issuing another deal, but being able to do so at an accelerated basis. Unlikely that we'd ever see that structure apply to a new issuer, or somebody that's not as well known to the market.
John, anything from you on that to add?
I'll leave it with Evan's wise wisdom on the master trust. Yeah, thanks.
Okay. Well, with that, I think we've come to the end of the session unless either of you have any sort of wise words.
I just have something to add. So I think this is going to be my last participation. Sorry to spring it on you, John. But it's really been a great run. I want to thank ISTAT, for the opportunity, to be participating in the Learning Lab since 2021. I hope we've added some value to, members, giving them some perspective of, the chaos and trying to make some sense out of the chaos in the area BS market over the last few years. But given the recovery, I'm out of a job. But I am moving on to a new project. I'm going to be working with the folks at AvBench and helping to introduce their reports to the lessor and financial community, which I think are very good. So I just want to thank John and ISTAT again, for having, this opportunity over the last couple of years. It's been a lot of fun.
Well, thanks very much for that, Evan. In terms of the questions that we haven't been able to take, I don't know if we have people that we know have submitted. I think we could potentially revert to them as well, separately, bilaterally. But for those, I think, that were submitted anonymously, that might be a bit more difficult, but we'll try and sort something out.
Yeah, absolutely. And we went through some of the material pretty quickly, so anybody that wants to reach out to John or myself directly, that's, love to hear from you.
With that, I think we can conclude this evening or this morning session. Thank you very much, both.
Thanks, Marilyn. Thanks, Evan. Thanks to all.
Thanks, John.
Thanks all.